Let's get down to actionables now, and what investors should be doing. I know most portfolios haven't done half as well as the index itself, and there is still a feeling of, FOMO in that sense. What do you recommend investors should do? Should they take profits off the table, reinvest it in a staggered manner? Would you recommend them keeping some dry powder for a potential correction and a better opportunity to buy? If yes, what sort of levels would those be? Because from where we stand right now, we definitely have borrowed significant returns from the future already.
So I think, Samina, wherever your stocks are trading at north of 50, 55 times on a 1 year forward, I think that's the answer is very evident. You can certainly sell. I think where you can move in is where valuations are still reasonable. I still think in the BFSI sector as a whole, valuations are not demanding. I mean, the elephant in the room, HDFC Bank, currently trades at about 2.2 times 1 year forward price to book. They've grown their NIS by 26%, their profits by 35%. I mean, I don't know what else the street wants from this company, but I think, names like this, I think you have value picks even in the insurance sector. I think there is some value even on the gold finance side, something like a Manappuram Finance, where for a 16-18% return on equity trading at 1 times price to book. So I think definitely BFSI is one place where you could look at. I think technically, Samina, the market was underweight on IT services. And I think that's why, barring Wipro, I think the other IT results that you have seen have been very easily bought into. Add to that the potential, noise that has been increasing as far as the Trump presidency goes. I mean, a lot of polls are putting him ahead. That could potentially bode well, because I think if you look at, how globally things stack up under Republicans versus Democrats, the overall environment may actually be more conducive towards spending in the United States, particularly because Trump is a capitalist. And given the BFSI exposure that you have for Indian IT companies, I think IT could be an interesting play as well. And go back to where we started this conversation, Samina, if the government does indeed decide to tilt a little bit towards consumption, again, that same technical factor of under ownership is there in consumer staples. So I think there could be potentially some interest moving into names like an ITC, Dabur, etc., if the rural recovery takes place. So I think there are still some pockets. And lastly, maybe cement. I know Ultratech wasn't a great bag, but I think that could potentially, because the first order that the Prime Minister signed when he came back into office was a housing order. And I think NHAI's, road allotments last year were not that good. They'll probably pick up this year. So I think these are 3-4 sectors where valuations are not as demanding today as probably the rest of the market are. So you can certainly take profits in companies where, your stocks are trading north of 50, 55 times and look at entering some of these stocks and sectors.
Okay, so that's BFSI, insurance, consumer staples, cement. Rahul's been kind enough to name a few like HDFC Bank and the likes of a Dabur that one could allocate to an IT as well. Gautam, what about you? What does your portfolio stand currently? Have you recommended to your clients to sit on cash? If yes, how much? And if there is a re-entry point, where would that be and where would that money go into?
So we just published our model portfolio a fortnight back. We made several changes. We had gone overweight on IT, overweight on pharma from being underweight and neutral earlier. We have reduced auto from overweight to underweight now. We continue to be significantly overweight on PSU banks. We find valuations very attractive even now. In private banks, we are slightly underweight because of our underweight stance on HDFC Bank since 2 years now. So that stance continues, but within the private sector banks, we are overweight on ICICI and Axis. Then we are overweight on industrials and real estate, which played out beautifully. But now we have to reassess given where relative risk reward lies. And as far as underweight is concerned, we are still underweight on energy. We are underweight on metals and also on cement. So our entire capex and industrials weight is lying in capital goods and minor weight in defense. And of course, big overweight on real estate. So net-net, we are trying to move the portfolio slightly more defensive, which is why you have seen a change in allocation towards IT and pharma. And then in consumption, we have a huge weight. We have about 20% weight in consumption, but within that, discretionary has been our preferred choice. So out of that 20% weight, staples is only 4% and 15% is consumer discretionary, where we have names belonging to jewelry, hotel, QSR, food delivery, then cables and wires, all sorts of things. So from a slightly longer term perspective, we've been more positive on discretionary versus staples. But staples opportunistically one can play for this budget event. I don't expect any significant pickup in volume growth there. Maybe something which is growing at 2-3% volume can grow at 4-5, but it won't change the trajectory of earnings growth beyond a point.
Interesting. So between Rahul and Gautam, I've got a couple of sectors that are common, while there are also a few sectors that are, opposites. But great talking to both of you, gentlemen. It's always a pleasure to have these conversations. Of course, budget, while we move on from it in 24 hours, is significant because we get an opportunity to talk to market veterans and build some perspective out for our viewers.